Welcome to RenMac Off Script. We're open to discuss markets, economics, policy, history, and life. It's the 10th of May, 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account at RenMac LLC and our LinkedIn account. We're going to hit today a little bit on consumer credit. We're going to preview next week. There's some fireworks going on at the FDIC, which we'll touch on, and this never-ending treadmill of Trump court cases. So we'll hit a couple of those and talk a little bit about China and the momentum call. But let's start with this FDIC hearing. I know, Steve, hearings aren't all that interesting or fun. I mean, it's just, kind of tedious, I think is the right word. But this one might be a little different. I mean, if only RenMac were as much fun as the FDIC. What's going on there?
Well, it is. When you go back to the November Wall Street Journal expose, it read like Wall Street in the 80s with just cocaine and a lot of extramarital activities, to say the least, and clearly a toxic work environment for a lot of unfortunately, the women there. And then as a response to that, the FDIC enlisted a third-party law firm to conduct a report, basically, were these findings true? And they found out that not only were they true, they were actually worse than the report suggested. And now the FDIC chair, Martin Gruenberg, is going to, maybe coincidentally, face lawmakers in the House on Wednesday and then the Senate Thursday as part of a semi-annual, prudential regulatory hearing, and he will probably get most, if not all, the questions from Republican lawmakers at a minimum. And I think just in terms of why does this matter, aside from just more of a sort of salacious story, people can read into the findings or check out our reports from this week to get into some of it. But really, it's about what can the FDIC do, and because it's a five-body governing institution, if Gruenberg goes, it'll be deadlocked at 2-2, and that will effectively end a lot of the Biden regulatory agenda. And there's this push right now to really expedite this because you have the Congressional Review Act, which basically gives lawmakers a 60 legislative day look back. And believe it or not, because lawmakers tend to be gone most of the fall campaigning to keep their jobs, which is their biggest priority, we're coming up pretty close on that legislative look back. So there's a big rush to move forward with this. Like both sides, often trade positions depending on, which parties in the White House. So you have a lot of Democrats rushing to defend Gruenberg because they know they can't confirm a replacement, and they know they don't want to see their banking regulatory rules die. And so now you have the likes of Elizabeth Warren and Maxine Waters and Karine Jean-Pierre saying, well, he apologized. I don't know if they will apply that same standard if Trump gets into office, if any of his, appointed czars, so to speak, run into similar issues. But, and then Republicans are obviously criticizing him. And again, if Trump returns to office, are they going to be as quick to judge? So the hearing is important because if he fails, then it may just be harder for Democrats to sustain him. They may just at some point just be like, look, we have to get rid of the guy. So I think that's what people are watching.
Small cap banks have changed trend, and they've started to break out, and they're actually acting a lot better, kind of, mysteriously, but it might be linked just to this, right? With a lower regulatory burden, possibly.
Well, I think so. I mean, I think, obviously the ability to impose a lot of these rules has come into question a little bit more now as a result of this. And again, as we sort of have this pile up, but not just banking regulations, you have a pile up of all these other regulations coming forth. So I think, that's probably looking less likely. And obviously you can have a legal challenge, and depending on your bet on who's going to win the election. So all these things are sort of piling up. And we did have a bank hearing last week with respect to mergers activities in the space. And that seems to be maybe dragging a little bit longer, making it less likely that is going to happen this year. So, you might, potentially be seeing a reaction to that, a little more open. I know the administration's been pretty aggressive in trying to promote their antitrust in most other areas, but Treasury Secretary Janet Yellen has suggested definitely last year that there could be more consolidation in the banking industry, and maybe that's looking better for some of these smaller banks.
Yeah. Well, we'll see. We'll do next week. We'll compare and contrast the Tom Brady roast to these hearings and see which one was funnier and more shocking. Neil, I mean, you've got your New Jersey tuxedo on. I see. You're just missing like the cigarettes rolled up in your arm sleeve.
I don't get it.
Is that like a plain white T-shirt, like right out of the Fruit of the Loom?
Like James Dean?
Yeah.
No. I
Oh,
don't wear Fruit of the Loom, Jeff. I wear aloe. Aloe. I don't even know how you say it. That's what this is.
all right. So let's talk about consumer credit. And I know we're gonna preview next week because it's a busy week, but there's a lot of concern about consumer credit and the consumers tapped out. You don't think that that's the case, and the data doesn't suggest it. Maybe on the surface it looks like that, but you've got a little different take on it. What do you think?
Well, I mean, you always have these sort of charts that are thrown out, like look at the level of consumer credit, it's going to the moon, and now it's I mean, obviously a lot of these numbers are just expressed in nominal terms. So, if you look at incomes, they're also going straight up as well, generally. So when you take a ratio of consumer credit, revolving credit to income, I mean, it's really no higher than it was before the pandemic, which would sort of speak to the idea that it's incomes that are driving the boat here, more so than consumer credit. And you kind of have to ask yourself, I mean, people make, I think, a little bit, sort of, it's one of these things where it's bad both ways, right? Like if consumer credit goes up, that's bad because it means that people are stretching themselves. But if it goes down, that's also bad because it means the economy is slowing. So a lot of the time, it's one of these. Whenever you have an indicator where people are kind of talking about it in that way, you should always kind of be on alert for essentially BS. And I think that's kind of what's going on here. There are some areas of the credit markets with respect to consumer credit that have shown sort of rising delinquencies for subprime borrowers. But the overall picture, I think, remains pretty good. And, consumers, bank willingness to extend loans to consumers, I mean, that's not getting any worse, frankly. I mean, we saw that in the senior loan officer survey. So bank willingness to make consumer loans, that you could say got less bad in the latest quarter. So, my sense is that it's really incomes that are driving the consumption story. Credit isn't much of a headwind or a tailwind. And I think a lot of the sort of alarmism that's out there is really just deliberately, frankly, misleading because you're looking at a nominal dollar value and you're not adjusting it for what's happening with consumption or income. And when you do that, you can basically see that a revolving credit relative to disposable income is actually lower today than it was right at the onset of the pandemic.
And how about purchasing applications, home mortgage applications? That data was out. Any change there? Anything that
I mean, the
jumped out to
housing
you?
market was a big driver for GDP growth in the first quarter.
Yep.
Now, a lot of that is a lag response to the lower mortgage rates we saw at the end of Q4. We know that mortgage rates kind of backed up a little bit. They've been coming down recently, but they've generally been higher. Residential investment added about 0.5 percentage point to growth in the first quarter. It's unlikely that continues. You're not going to see transactions rise as rapidly as you did in Q1. So that'll kind of weigh on broker commissions. And we've seen construction activity moderate as well. So, I think it's just, housing is kind of, it's going to be less of a tailwind, I think, going forward. And I think that's the way to think about it right now.
Yeah, I mean, and this requires a little bit of artistic license, but in our market cycle clock, we're in a zone where short rates historically decline. They usually contract by about 22%. So that'd be, something in the high threes, right? On an annualized basis. But it looks like a top formation to us in the 2-year yield. You tried to poke it through that 480. You've since rolled that over, and there is good support down around 425, but it certainly looks like a good risk reward scenario on the short end of the curve. And I think that gels really nicely from an equity market perspective for not only seasonality, which in an election year tends to be very strong in the summer, but also this resolution of the oversold condition that we had a couple of weeks ago, 2 or 3 weeks ago now. We made a 20-day high. I think importantly, and kind of at the margin where people aren't expecting this, is breadth. NYSE breadth actually did make a new cycle high. So that confirms the uptrend in our view. But You know, if we get short rates coming in by say 25, maybe 50 basis points over the next 3 to 6 months, I mean, you got to view that as pretty bullish for the equity markets, don't you, Neil?
Well, bullish for the equity markets, bullish for housing. I mean, I
Yeah.
think, it's sort of, you need to see like it's a sequence of events. Inflation has to slow, you'd
Right.
expect bond markets to rally, Fed to cut, and then housing will be more of a push maybe towards the end of this year. I mean, that's kind of how we're gaming it out, and you'd expect equities to kind of discount that going forward. Yeah, I mean, I think, to me, it's still very compelling to expect the Fed to be cutting this year. I mean, a couple of weeks ago, people were talking about, well, maybe there's a 15 or 20% chance the Fed starts hiking again. I find that, I'd be fading that, frankly. There isn't to me, most people can't actually properly articulate why core inflation rose so rapidly in the first quarter, right? Because was it because inflation expectations surged? No. Was it because unit labor costs were on the rise? No. Was it because the dollar was cratering? No. Based on sort of like first principles, it's kind of difficult to say why inflation perked up. There were a lot of idiosyncratic factors that pushed things up. Like healthcare services inflation, financial services inflation. We had some weirdness around OER and primary rents that probably shouldn't last going forward. But I think you always have to stick to first principles. You have to be able to explain why something's happening. You can't just point to the indicator itself and be like, see.
Right.
You have to try to explain it. That's our job. And I think when I apply those first principles, to me, it's a pretty compelling case for weaker inflation this year. I think as inflation slows, that'll probably nudge the Fed along to recalibrate policy. I wouldn't get too carried away with how much they can cut, frankly,
Right.
because if you have mortgage rates dropping to like 5.5%, 6%, I mean, you're going to push a lot of refinancing activity out into the market, which will, I think, kind of short circuit a lot of the enthusiasm, right? Because around rate cuts, right? Because if you bring a lot of people off the sidelines with very modest declines in the Fed funds rate, then that limits how far you can actually cut the Fed's fund rate in the first
No
place.
doubt.
So
I would just add, it wouldn't be just bullish for equities, be bullish for Biden's reelection efforts. I
No
mean,
doubt, right?
when you're looking at
Biden is a call option on the American economy, right?
yeah, no, I would agree. I mean, we talked a little bit about why, voters may still be frustrated. And you look at the polling regarding younger voters. I know there's a lot of attention played to what's going on in Gaza, but when you look into the polling data, younger voters are expressing frustration on the economy. And it sort of ties in, I think, to interest rates. When you talk about your ability to buy a car, ability to get a house. I mean, clearly there's some frustration here. And even to those early, family scenarios, I can speak to this. I mean, trying to deal with increased prices, but also trying to manage, okay, make those decisions. How much do I stock away for retirement versus, these ballooning education costs for my kids? I mean, I really think that's playing a role here. So anything that they could do to help alleviate that, at least the perception of that, that's heading in the right direction. That's why I think this whole political focus on the Fed cutting interest rates is significant, because I think that's what Biden is hoping on, to just send that message where the worst is behind us, to try to win back some of those younger voters.
Yeah. I mean, look, the Raging Cajun got it right 30 years ago. It's the economy, stupid. People vote, in their own self-interest. I mean, as you would expect, right? I mean, at some point you're gonna shy away from what's happening globally, and your marches for what's happening in your pocketbook. I mean, first and foremost, you got to figure that one out, and then you can, go save the world. So I think they're starting to get that. Speaking of the world, though, let's talk a little bit about China, because China continues to, exhibit those signs of a trend change. Really, the momentum is being seen in Hong Kong, which is the close cousin of Chinese equities, without the potential risk of the Communist Party absconding with your funds. So we're seeing a little bit more in the momentum in China. But one of the things this week that we went through and looked at was, where the leadership is in China from a sector perspective. And I would just say, historically, one of the first things I look at when we're seeing a turn in the U.S. market, both upside and to the downside, is what the relative performance is in consumer discretionary. Consumer discretionary names, in aggregate on an equal weighted basis, almost perfectly are contrarian to what you would otherwise expect in the marketplace. In other words, when the consumer is broke, when they're out of a job, when they've maxed out their credit card, consumer stocks tend to bottom out and improve. It's the news couldn't be worse when consumer stocks tend to do the best, and just the opposite when the consumer is flush, when they're fully employed, when things look great, and things are perking up. The consumer stocks tend to underperform. So the reason I bring this up is because the leadership in China has actually been consumer discretionary names, followed pretty quickly or closely by the material names. And we continue to see this breakout in copper, the follow through. There was some random name that I hadn't even heard of in our breakout alert list this morning. We posted it on Twitter in Europe in terms of copper, but we are seeing these materials. And the reason that all this is important is because the momentum contraction that we had, that we talked about 3 months ago, that momentum was stretched, it was likely to contract, that has happened. We took technology momentum from the 94th percentile now down to the 37th percentile. So clearly that reversion trade where high momentum names versus low momentum names start to compress and come together, that has taken place, probably continues. But what the real message is that you tend to get this rotation after you have those momentum extremes, and that population of high momentum names generally turns over. So we are on high alert looking for where is this next rotation going to lead us, and how does that play out? We've seen some improvement in utilities that they were in that bottom momentum cohort portfolio. And what's interesting is it's really a reminder back, when I was in the business back in the late 1990s, 1999, forever ago, 25 years ago, there was this pocket, probably 6 weeks, it certainly wasn't long, where utility stocks did extraordinarily well because people were using them as the third and fourth derivative for the internet play. That's how you're going to get internet into your house, was you're going to be able to use the pipes of these public utilities to deliver high-speed internet into every house. And so all of a sudden the utilities just started to outperform and have these massive moves, which obviously in hindsight is laughable. But that's what happens when things get kind of stretched and the enthusiasm starts to bubble over. People search for the third, fourth derivative of that. We talked about airline pricing with Ozempic, right? People were talking about how much fuel these airlines were going to save because you'd have skinnier passengers. So there's a little bit of this deja vu in utilities here that we think is the rally is certainly being driven more by not only the seasonal factors, but that stretch in momentum that's now reverting as we go.
But if
Neil,
rates drop, right? Wouldn't you expect utilities to outperform?
yeah, there should be some of that for sure from the bond proxy side. But what ends up historically happening is when people look at utilities and they look at rates dropping, they tend to move towards cyclicality. Even though utilities will go up, you're like, why am I going to mess around with a 4.5% dividend yield when I can, get a 50% return in Caterpillar, right? So they kind of think towards cyclicality because you get the beta in there. So, and we would certainly be, skewing ourselves towards beta away from momentum at this juncture.
The China thing is very interesting. You mentioned, China, right? This was on the Herd in the Street column today in the Wall Street Journal. Chinese stocks rebound, but foundation for rallies still weak. I mean, when you get headlines like that in the journal, maybe that's probably a reason to keep
Love it.
piling into the trade. I mean,
They started a cash for
incredulous-
clunkers program over there, and I know that they also, I think, relaxed some of their property restrictions. So, it's interesting to me just from the geopolitical angle, because at first we saw all these concerns about overcapacity, that somehow they were going to export their way out of their fears of a slowing economy. Now maybe this idea that to try to do both, maybe they're, because of the pushback from the U.S. and Europe that we talked about last week, there's more of an effort to do more of a domestic stimulus, maybe in addition to that. So I think something to watch as we're hearing.
Their program is cash for capitalists.
Something like that. I don't know how many of them, but there are very few of them over there.
Turn in your capitalist neighbor and get money for it. Neil, what's on the docket next week for the data. It's a busy week, right?
A very busy week. We have the CPI number coming out. The market right now is looking for 0.3 on core CPI inflation. That would be a modest deceleration from what we saw in March, which was 0.4%. I mean, we'll see. You know, these numbers have been very, very difficult to forecast. The year-over-year rate should step down to 3.6%. That's where the consensus is. You know, I'm inclined to think that at some point in the next few months, there's just this big downside surprise number that's out there, right? You get this sort of disinflation from core goods. You get, you know, normalized housing rents, and you know, you're basically talking about a CPI number that translates to maybe 0.1 on core PCE. I think that number's frankly out there, and
out there this summer. Out there, what's the time frame? Do you think?
I mean, by the end of the spring, could be happening soon. I mean,
all right.
You know, just
So I should go get long my short end futures. Absolutely.
I think that, you know, if we're right about the way things are going to unfold this year, it's, you know, you should frankly pick bonds over stocks. I mean, at least for a trade. So yeah, that's how I would be thinking about it. We're also getting data on retail sales. Again, this is an April data point. You know, we had a very strong month for retail sales in March. A lot of that was driven by e-commerce. The underlying sort of subcomponents weren't as strong, so you didn't have a strong breadth in terms of the retail sales number. But the consensus is looking for you know, basically 0.1 on control sales. That would be a pretty significant step down from where we were at in March. A lot of the high frequency data has been fine. I mean, if you look at credit card data, same store sales, you know, those have been fine. So it could just be sort of a seasonality kind of thing going on with the April number. But you know, you'd expect a somewhat slower pace of consumer spending in April relative to March.
Steve, what's happening in the swamp?
Well, we talked about the hearings next week, but in addition to that, I'd watch Thursday. The SEC is actually holding a conference on emerging threats in the asset management industry, and that's usually a good indication of where they're likely to move on the regulatory front. They sort of, you know, bring everybody in, identify what they see as the threats, and then respond after that. Again, whether or not they're going to be able to pursue this in time, we sort of talked about, and will depend heavily on the election. So that's sort of what I'm keeping an eye on. In addition to the FAA bill, Senate passed their version last night, but they did agree to sort of give the House some time to return next week after they did a 1-week extension. The big thing to note there is that the amendments were pretty much confined to those relating to transportation, which might sound like common sense, but because this is one of the few legislative trains leaving the station, a lot of unrelated bills with respect to marijuana, banking, a credit card competition act and the like, we're hoping to try to hitch a ride, and they weren't able to do that. So,
well, we'll be watching the S&P resistance level, which is the old high, and that is just within striking distance, frankly. So we're right there, which is 52.64 on the S&P, really less than 1% away. The good news is if we break through that, you put another 300 points on the target. So that pushes you up upwards of 5,500, almost 5,600 on the S&P target from that point on a breakout. So good news, again, consistent with the seasonality, and man, with a little tailwind from the short rates coming in, be helpful on that. But again, new high in breadth, all that would be or does underscore the point that we are still in a bull market. On the 10-year, 480 is resistance, 435 is support on those yields. Bitcoin support, 59,755. We talked about that before, with a resistance at 72,800. Still looks like just a big consolidation. And I would note, even though we're not quite oversold yet in gold, this consolidation that we're seeing in gold is absolutely what you'd expect after an overbought condition. Very orderly, looks very good. The 50 days coming up to meet gold, which is a nice consolidation point. Still looks like a new bull market. Well, join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and LinkedIn. And if you want deeper insight, join us at RenMacAccess.com. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
and I'm Steve Pavlik.
We'll see you.